Well, at a time when there are few IPOs and few private equity deals, K.K.R. may take discount retailer Dollar General public and underwrite the deal. Well, that is all according to the Wall Street Journal. For more on this unusual deal and the private equity picture in general, we're joined by Steven Kaplan. He's professor at the University of Chicago Graduate School of Business. Professor, thanks so much for being with us.
You're welcome. Good morning.
What does this tell you that K.K.R. is not only underwriting this IPO, but of course issuing it as well?
Well, it tells you that they have a successful company, Dollar General, and when you have a successful company and you can take it public, you do. So they are doing it because they want to make their fund look good. And I think they're also underwriting it because they've said they want to move into investment banking and they want to showcase that they can actually do that.
And what better way than with a company that they bought, of course. What does K.K.R., though, have to accomplish here, Professor?
What do they have to accomplish? I think first they have to get the company out in public at a good valuation so that they show that the value has increased. What that does for them is that allows them to mark up their portfolio and tell their investors, their institutional investors, that they've done a good job. I think secondly, they want the IPO to be successful because if they're going to move into this business, obviously they want it to be successful for their own deals, because the real challenge for them is going to be whether anybody else wants to hire them who is not owned by K.K.R.
Professor, in general, I'm just wondering, I mean, the joke right now about private equity is that they have a lot of money that they can't spend. So does this particular deal signal maybe a change and a trend that we may see?
Well, they're not spending money, they're getting money back. And that's a good thing because they can give money back to their investors who are committed to then giving money back to K.K.R. And this at least tells the investors your investments are ultimately going to pay off. It doesn't say yet that they're going to spend the money because they're not.
But, you know, given this downturn, of course, Professor, aren't assets out there so cheaply priced that we should be seeing more private equity deals, seeing them spend more of this money?
You would think so, but there are two reasons why it's been slow. First of all, anytime to have a deal, you need a buyer and a seller. And the sellers just haven't been willing to sell because they remember the days a year or two ago when assets were 10, 12 times EBITDA, and they don't want to sell for, say, 6 times EBITDA. That's cash flow. And so there's been a hesitance on the part of the sellers to sell. That's one. Two, to do a deal, you need some bank financing usually, and obviously that has been very hard to come by.
Right. Debt financing has been very hard to come by. Professor, just in terms of the financials, buying up the bank assets, is that a whole different ball game right now for private equity firms because of the recent regulations coming out?
It certainly is. It's attractive in theory to private equity because the leverage is already there, right? You don't need to find leverage. Banks' business is leverage. So that's why they've been attracted to it. I think the real problem with doing that is the government. And, you know, it's the old line, we're from the government, we're here to help, which I think the private equity firms have been discovering is not a joke.
Okay, Steven Kaplan, thank you so much for joining us, professor at the University of Chicago.